the sell-off. One top strategist is telling investors, don't panic. There's a big rally ahead, and he will be there to explain.
Welcome back. Another rough day for Wall Street. A sea of red for stocks. The Dow losing over 800 points in the last two trading days, 602 points today. Joining us on the phone, Russ Kosterich from BlackRock. Russ, thanks for joining us. With the selling today overdone?
Well, I think the selling today is a continuation of what we've been in since really October, which is investors coming to grips with two facts. One of which is that global growth is slowing, particularly in China, and the other is that financial conditions are tightening. So I think we will get some more volatility, particularly until we have more clarity about the Fed and the price of money, which right now is one of the biggest drivers of volatility this year.
What kind of clarity do you mean?
Well, the fact is, we've had a pretty clear message from the Fed that they don't yet view either the developments in China or Europe or tariffs or the market volatility, for that matter, as enough of an issue to diverge from their rate. I think as long as that's going on, in other words, rates are going up, financial conditions are tightening in an environment in which global growth is slowing, that is a much tougher environment for global equities than we've experienced for the last several years.
Russ, if this period is just an adjustment period to perhaps a little bit of a slower growth phase and maybe rates normalizing but stopping at some point next year, just imagining that it's not necessarily kind of on the precipice of recession, has the market generated a lot of value in certain sectors by really trashing a lot of stocks and segments of the market here? Or do you actually think it's time to just kind of hunker down in some of the more stable parts of the market?
No, I think it has created value, and it's probably a combination of which. We've been lowering our risk within the Global Allocation Fund. We do think you want to get a little bit more defensive, have more of a focus on quality. That said, there are parts of the market that are on sale right now. To begin with, outside of the U.S., stocks were not particularly expensive when we started the year, and they're certainly much cheaper now in places like Japan and emerging markets. I'd say closer to home, we're finding very good value in the energy sector. Just a very simple exercise. If you look at the price to book of energy stocks in the U.S. right now, they're close to the lowest they've ever been relative to the market. And we're still in an environment where oil is at $60 a barrel. It's not at 40 the way it was in 2016. So I do think there are pockets of value in the market today that investors want to take a look at.
What about technology, Russ? What do you tell people, especially the hot FANG stocks, no longer so hot?
I think in technology, you've got to pick your spots. Now, the good news is I never thought technology was in a bubble. We've seen a fairly significant correction, but year to date, technology doesn't look that bad. And I think there are parts of the market where we see value in technology. But I'd say, again, some of the best opportunities we see in tech right now are actually outside the United States because the starting valuations were lower, and they've actually been punished even more.
All right, Russ Kostrich, thank you for jumping on the CNBC Newsline with your take on today's sell-off and where there might be pockets of opportunity.
Thanks for having me.
BlackRock. Wildfires are still ravaging California. We're going to take you there for the latest next.
And big retail names like Macy's, Walmart, and Nordstrom finishing the day lower ahead of earnings later in the week. Dana Telsey will join us with the key numbers to watch.
Today.
Deadly wildfires are still ripping through California. Our Aditi Roy is in Camarillo with the very latest. Aditi.
Hi there, Sarah. We are at the command center for the Woolsey fire. Between this fire and the one up north, the Camp Fire, there have been 31 fatalities. And beyond the tragedy of these deaths, we are also seeing a huge impact on markets as investors fear that California utilities might be held liable for some of these losses. State regulators are looking into Pacific Gas and Electric and Southern California Edison, owned by Edison International, after both companies reported malfunctions shortly before the fire started. Shares of both companies plunging by double digits today. PG&E is being blamed for a number of fires in Northern California this past year as well. We're also seeing new numbers for property loss projections. CoreLogic says the total reconstruction value of the more than 48,000 homes that are in extreme or high danger in the Woolsey and Camp Fires is about $18 billion. Now, Zillow reporting that nearly 22,000 homes are threatened in the Woolsey and Hill fires. Those are both down here in Southern California, and those have a combined value of $42.2 billion. The causes of all of these wildfires are still under investigation. Guys, back to you.
Aditi Roy, thank you for the update from California this afternoon. A big sell-off on Wall Street today. Can retail earnings this week turn things around? We're going to discuss that next. Big week for retail earnings. Home Depot, Macy's, Nordstrom among some of the big names reporting. Dana Telsey from Telsey Advisory Group joins us with what to expect. So, Dana, there's a lot of wreckage right now over the past month in some of these names. What looks good ahead of earnings?
I think ahead of earnings, some of the names that look good, I think we could have a good quarter for Nordstrom. I think Kohl's, with all the new brands that they've been putting in their stores, is certainly helping to drive traffic. I think these off-pricers, like a Burlington stores, like Ross and TJ, are also going to continue to get the benefit from traffic. The headwinds that we faced in the third quarter were warmer weather in the beginning of September. And so I think people are going to want to hear that business has picked up since then and in October and perhaps quarter to date. And they're also going to want to hear a little bit about tourist trends. We heard from Ralph Lauren last week that tourist trends inched down a little bit in this current quarter. I think that could be a headwind for some of the companies that needs to be offset with stronger local demand.
Where do you stand on the likes of Walmart, Target, for example? Walmart, of course, reporting later this week.
Yep, Walmart reports later this week. Target we have coming up. I think what's interesting is the Toys R Us closures. 70% of the store closures overlap with Toys R Us, with Target. So we can have a big benefit from Target coming from some of those toy closures. And they should be able to garner some of those sales. Everyone is out there looking to get those sales. I also think Walmart's going to have a good quarter, too. We heard from them at their Investor Day a couple weeks ago, and the strength that they're seeing both from supply chain, logistics, I think has been enhanced. I think the discounters are prepared to take advantage of a consumer that's stronger. They have more dollars in their wallet, and they have more money to spend.
Dana, what's your sense in terms of how the market is handicapping just how strong holiday sales will be across the board? Is the sector priced for a big acceleration in holiday sales, and would that leave room for disappointment down the road?
What I worry about is I worry about the first half of 2019. We just put out our holiday forecast today, and we're looking for a 5.2% increase. It should be a strong holiday, given the fact that consumer confidence, you have product innovation that's out there, a rebound in apparel coming on. But when you think about the first half of 19, what do we have? We're lapping. We're lapping wage benefits. We're lapping tax benefits that we've seen. We're also lapping a perfect weather. So overall, I think the group, you need to surprise to the upside in order to drive some of these stocks significantly higher.
See what the week brings. Dana Telsey, thank you for joining us with some picks ahead of earnings this week. We also get retail sales. Mike, we're coming off a down 600 day on the Dow. What do we watch tomorrow?
It's just another kind of oppressive air pocket. I think it's how the market itself, kind of whether it finds its footing at these levels. Again, we're closed on the S&P where we did a week ago Friday. So these bounce attempts have not really had any follow through. Doesn't mean it's not going to work one of these times. There is kind of a formation developing on the chart. Some people think it looks like it could become a relatively decent bottom.
Bond markets open up again, having been closed today. The guess is it's going to see a risk-off move and some buying of the bonds yields lower.
That's the indication from how the bond futures traded. So essentially that would take some of the yield pressure away. Not sure if that's bullish in an immediate term.
I just wonder if we're in a place sort of negativity with sentiment where something needs to happen. Either the Fed has to change its tone, or we have to see some development with Xi and Trump on trade talks. Is that what we're looking for?
Those would be the two areas that you would say, yeah, that's where we'd likely get a little bit of relief. But again, the market's in this very tactical zone of essentially, bidders staying away until they see if certain levels hold. And I think that's the game we're playing right now.
Also keep an eye on Goldman Sachs tomorrow morning if it can find a bottom. The dollar, Sarah, as well, continued its strength today after the market close. Still high from the close.
Which is starting to pressure equities.
That does it for Closing Bell today.
Fast Money with Joe Kernan begins right now.
Yes, it does. Fast Money starts right now, live from the NASDAQ market site overlooking New York's Times Square. I'm Joe Kernan, in for Melissa Lee, feeling pretty comfortable here, pretty much at home. Thank you. You lent us this desk for a while before we moved downstairs on Squawk Box. These guys are my friends here, Pete Najarian, Steve Grasso, Brian Kelly, and Tim Seymour. I wish it was a better reason for us to be together tonight, but it's not. We're going to start with the market sell-off. Once the market started selling today, it really didn't let up. The Dow sinking 600 points, closing near the lows of the day. The losses accelerating as it seems to do in the last hour of trading. Tech leading the way big time to the downside. NASDAQ weaker than the other averages. For more on the wild day on Wall Street, let's get to Bob Pisani for the details. Robert.
Hello there, Joe. Good to see you. The market is boxed in due to the problems with the Fed and global growth. Those are the two issues. So today's decline in tech can't be blamed exclusively on Apple. All right, it was down 5%. Lumentum, one of Apple's facial recognition suppliers, reduced its outlook for the quarter, citing a reduced shipment request from one of its biggest customers, which everyone assumes is Apple, probably correctly. Other Apple suppliers, Qorvo, Cirrus Logic, JBL, they were all weak, along with big semiconductors like AMD, NVIDIA, and ST Micro. But the fact that all the FANG names like Amazon, Facebook, Netflix were down 2 to 3%, and the industrial and the energy sectors were down 1.5% each. It points to a much bigger problem than Apple. Domestic growth seems strong, and it is, but the global growth picture in Europe and China is generally weaker. And that's one reason all the high valuation stuff like the FANG names are getting taken down. Now, the tariff issue is also greatly complicating the global growth picture. Nobody can quite figure out what's going to happen with that either. Another problem is the strong dollar, which is a result of the Fed raising rates, also a result of Brexit problems, a weak euro like Italy and weak European economy, and of course a weaker China. That all plays into the stew. That strong dollar is hurting commodities in turn with double-digit declines this year. We've seen in copper, in aluminum, and zinc, and lumber. Look at all these. The recent decline in oil is being blamed on oversupply issues, but it's likely that concerns about a slowdown in demand may also be a factor in the decline of oil. Unfortunately, the Fed is boxed in as well. The market is implying it wants the Fed to slow down on rate hikes. But with the current economic news, it can't do that. The news is too good, and it won't be able to until December at the very earliest, and even then that's going to be a tough call. So the bottom line here, the two issues the market cannot answer right now is where is global growth and what is the Fed tightening picture going to be in 2019. Good to see you, Joe.
Good to see you, Bob. I mean, we're getting a little bit acclimated to this. When was it? It was a Wednesday. We were up 500. I mean, these are 2% moves. It'd be good to get used to feeling what 2% is at 26,000 or whatever, right? I mean, it's still it's still heart-wrenching, but it's not, it's not like 15%. Thank God.
It's you know what? It's appropriate for the VIX to be at and above 20 at this point. That's when I start paying attention for a simple reason. The market is confused because it can't figure out what the global growth picture is going to be like, how strong are earnings going to be. We have 10% for 2019. Maybe it's going to be half of that. Some think it could be 1 or 2%. That's a big difference. That's a lot of confusion.
Yep.
The market should be volatile on that kind
Bob,
of
it kind of started this morning, and wow, I was here for that, in fact. It kind of started this morning with the new China intellectual property stuff. You could see the futures sold off before the market even opened, and you add that to everything else, and here we are. Anyway, thank you, Bob Pisani.
Okay.
We only have an hour,
That's it? Yeah. You guys go on a show, and it would be a good show.
Let's go that's what I got to get used to.
A half day for you.
I got to recalibrate.
It's a third day.
The question is simple tonight. What happened, and what do you do now? Pete, I'm just going to read a quick Jim Cramer tweet, and he'll be on at 6. I would tune into him. This day had no redeeming factors if you are a bull. None, capital N-O-N-E.
And I was on with Jim at noon today, and basically it's the same thing. And then we were down about 300 at the time. And I'll tell you, the acceleration of the downside is concerning. I'm surprised. Bob mentioned the VIX at 20. I'm surprised it didn't get up closer to maybe 23, 24, 25. Right. I mean, with that kind of a sell-off and the pressure that we were seeing, and the one name that's not part of FANG, but it is part of FANG, is Apple. Right. And when you see Apple down 5% in a single day, and it's a name that was just trading back up to 209 and pulled all the way back down to this 194, 95 range, that's been a couple of bad days for Apple, and that was the one name that was holding up. So the one disagreement I'd have with Bob right now is he said, well, it's not really just about Apple. I think it's a lot about Apple because people are looking at Apple as the one area, the bastion of where you can go and hang out.
You lost the last
There's
soldier.
some safety, and now that soldier,
you have Apple, you had oil, you had global growth, and to Pete's point, the last soldier in your defense, if you were a bull, was Apple. It was your value play. It was your growth play. Now, if you don't have Apple, you really don't have anything. Where are you putting your faith? Where are you putting your stock? Literally.
Right. And it's the reason why Apple fell, right? It wasn't because they might have had a bad quarter. It wasn't because they were worried about the dollar. It was because it looks like their sales are slowing down. So extrapolate that to everybody else, and that's where you have the problem. To me, nothing's really changed since before the election to now. The only thing we've taken off the table is kind of the election uncertainty. But beyond that, all the global growth concerns, all the Fed concerns, and the U.S. dollar is even higher. So to me, nothing's changed at all. It's appropriate to have these up and down 2% without a doubt.
So we're where we were last Friday before midterm elections. I think we probably sat around here sometime on Wednesday after that big rally, and I'm not saying we called this. I'm saying we said, hey, what's different? What's different is good news and bad news. Does gridlock in Washington mean something for markets different than what we were pricing in before? We're not sure. Maybe it means a more aggressive White House, which could be more negative on the trade front. The bottom line here is look at the move in the semis. That's a 7% pullback in essentially 2.5 days. They, to me, are the ultimate trade war victim and cyclical read. Between that and then let's talk about the dollar today. That, to me, is probably what has most people unnerved. Again, we've talked about the dollar being, Brian refers to it as the new VIX. Whatever you want to call, the dollar is a wrecking ball for risk assets, especially those inversely correlated to a dollar move. So bottom line here is dollar is also a flight to quality. The news out of the EU, Joe, is really, I think, what worries me most because we're starting to put pressure on Italy again, the EU budget, and all the headlines that we've had out of Europe and political discord. Those are not even talked about in the context.
But I think the biggest thing that you brought up, I think those are spot on, is the Fed and now the White House. If the White House isn't dictating or if the Republicans aren't owning every branch of government, are you going higher or lower? The reason for a lot of this rally was the pro-growth policies.
Yes.
Lower regulation. If you don't have that, you don't go as high.
Right. Well, the most bullish thing that we could have come out of the election was nothing gets undone. And that's what happened, right? We have this kind of, if you want to call it gridlock. But right now the problem is the market's pricing in nothing gets done. We had that huge rally, 500-point rally or so, on the idea that, all right, everything's going to stay status quo. But now things are starting to unwind a bit. I'm with Tim on Europe. I mean, a lot of people don't talk about it. We talked a little bit about Italy today, but the European situation, both in their economy and what's going on with Italian bonds, is spooking people.
But the biggest thing right now, it's still got to be trade policy, right? I mean, I hear everybody else, a lot of people talking about whether it's the dollar or the Fed or whatever it might be, but you look at trade policy, and isn't that one of the biggest headwinds? Because there's no clarity out there. I mean, we've gone through this earnings season, and what did we hear? We heard all the industrials, almost to a company, tell us how difficult it is to project forward because they have no idea. Right. They don't have clarity. Without clarity, when it's cloudy, it's tough.
You get trade. I would like to see, and I know I sound like I'm trying to thread the needle here, I would like to see a test of the lows, 2603, or a test of the February lows, and then I think we can rip higher with the clarity that Pete's talking about. We get anything positive out of the G20, anything positive. Anything at all, you rip higher.
I didn't know you were
threading the needle.
You knit?
I mean,
it seems like Stitch Fix, a needle point guy.
That's fantastic. Here's what I would just say about Apple, maybe to tie it back to the market, Joe, is bottom line here is whether it's Apple's 60 bips on the triple Qs move or not, the downgrade that came from J.P. Morgan today was really a function of, hey, we're looking at emerging markets. We're looking at slower growth. We're looking at a stronger dollar. So they're taking this company and they're actually dropping it right into an earnings profile that's not just a market dynamic. We're actually seeing it in that bellwether.
920 billion. I mean, it was just a trillion and 50 like a week ago.
A lot of hoopla
those
about
trillions
that.
of all.
We're going to hear that number. Was it 207 and a nickel? Remember we heard so much about that?
Any of you guys see 60 Minutes last night? Did you see?
Yes, Tim Cook.
What if that happens? No, but what if just the idea of this actually being my info, not... I never even thought about that. Is my info, or is it Google?
Right.
I just thought it was Google's. I really did. I mean, this guy made the case. It is not. It's mine. If that comes here, I'm worried about everybody but Apple at that point, right?
You've got it because they can't even figure out how much it's going to cost them to comply with GDPR in Europe. So that change is happening, and the business models of a lot of these companies, a lot of these tech companies, are being threatened. I mean, it's like it's this peak centralization thesis.
Pete, I was watching a football game, obviously,
yeah,
and then 60 Minutes is coming on, and I was, I thought it was going to be Leslie Stahl again, and I was like, I got to. And then they actually were going to do something that I needed to, and I actually watched.
I only get one station on my television, Joe.
Squawk Box?
CNBC?
Yeah. Okay, all right, boy. For more on today's market sell-off, we're joined now by Julian Emanuel of BTIG, who I saw on Thursday, and you were in a great little mood on Squawk Box. We were up 500 the day before, remember?
Yeah.
How are you feeling today?
You know what? We said this is a process. This is a process. When you have a straight line sell-off like we had in the month of October, to expect a V bottom and sort of a race to the highs, completely the wrong way to think about it. 10% corrections tend to take from 60 to 200 days to regain the high. Okay, so that's the context. Second context is that November tends to be a positive return month. We still think it sorts itself out that way, but it actually stays volatile until the Thanksgiving holiday for the most part. And with Trump and Xi meeting on the 29th, expect it to stay volatile all the way till then. But then the third, the elephant in the room, we can't get around this. Basically, the market is saying is that political risk is higher. And it's obviously
higher since the midterm elections.
Well, so what is one of the issues that both Democrats and Republicans seem to agree on? And that is trade, a harder line against China. So that is something that
why isn't it still Powell? Especially with what happened to oil, global slowdown. When does he go from 1 next year instead of 3, or at least go to 2 more increase? I mean, Cramer's been talking about. When does he throw in the towel and say mission accomplished?
He won't say unlikely in December.
Then I don't know if it's trade.
But now that you have 8 meetings, you could very well say it in January, where you've got a press conference.
You think he's starting to waffle? Do you think he sees days like this and says, maybe I was a little bit too hawkish?
From our point of view, the Fed has, throughout history, tightened too long. And if you go back to the 06 tightening cycle, you didn't see financial conditions get materially tighter till it was too late. The problem here is if you don't have progress on the trade front, things could go south very quickly. And from our point of view, even if you don't have a material economic downturn, the potential for more multiple compression, you've already compressed 3 multiple points this year, is there in 2019.
But I guess that's where I would push at you, Julian. I mean, and congrats, because you come on here with ice water in your veins on down days, and you say the same thing, which I think is very constructive for people at home. Not because, you know, you just want to believe the same thing. I think you believe there's a process. I'm worried about S&P earnings in 2019. People tell us we're going to grow another, 7% next year. I don't think we will. I think the status quo has priced things wrong.
So to us, mid-single digits in an environment where the Fed takes its foot off the accelerator is going to be sufficient, particularly if you're taking off the pressure off the rest of the world. And then, we go back to trade again. Emerging markets have already taken it on the chin. Europe has already taken it on the chin. After the last few days, is the probability of auto tariffs against Europe lower or higher? It's probably a little higher. But these are the kinds of things that we have to deal with and realize that there is a material knock-on effect potential into 2019.
So, Julie, I'm curious. You're saying mid-single-digit returns for next year or earnings? Just I want to clear that up.
Earnings.
Okay.
Earnings.
So then you have volatility coming in. Wouldn't it be better just to buy bonds at 3% than deal with the single-digit earnings and volatility of 2% or more on any given day?
They're all interconnected. You look at this year, and even let's say we pull back to sort of flat on the year at some point, and bonds still have looked, quite poor. From our point of view, the story with bonds is a much longer-term circumstance that you really have changed the psychology over a 2 to 3 year period to where bonds look like the yields are going higher, looking out over the next 3, 5, 10 years, and that's the risk.
All right. Very good. This is a pretty easy show to do. I mean, you guys have a lot to say, don't you?
We're not afraid. We're not afraid.
Really, I've got very little to do.
It's unbelievable.
Watch this. Thank you, Julian. Now, are you ready for this?
Yeah.
Okay, I'm going to do it because it says it right here. Steve Grasso, are we heading for a year-end rally? What'd you do? Draw the short stick? You have to say.
I don't make a move.
I have to make a binary
Would you
binary move right here.
You know what?
I don't know the answer to the top of the show. I have it at the top of the A block, at the bottom of the A block.
It's unbelievable. So will there be?
So I think it's what Julian said. I think you have to get. I think you have to get a flush.
He's not even here right now.
He's been good guy. I didn't ask him what he said. I just told you what he said. So I am threading that needle again. I think you're going to see a sell-off. I think it's going to suck the most amount of people in as possible, and then we're going to rally into year end. So yes, December I see as a higher month.
One thing just to talk about today that concerned me was the move in oil after OPEC seemingly stepped in and said, we've got some resolve here. Oil finishes lower. Remember, the last time oil was potentially in this kind of a move where we were talking about too much supply, the dollar was getting stronger, and the rest of the world at least was concerned about lower growth. This was a very difficult time for risk assets, certainly for oil and certainly for ultimately the global
How can oil
risk
move?
market.
How can oil move higher when you have Russia, United States, and Saudi Arabia pumping at record
So you still
levels?
say supply. See, we argued this morning, was it supply or demand? And when with the Saudi news, it looked like it was supply because it was up this morning. It was up 1%.
Right. I think it's a
closed down by the end of the day. Then it's not supply. Maybe it is demand.
With the
How do you know?
Iranian sanctions, I think everyone was in a rush to pump a little bit more. So you had the Russians step on the gas, you had the Saudis step on the gas. But when you get waivers for a bunch of different countries, that can't help but cause a glut in the pipeline.
I hope you're right, because if it's demand, we're in a heap of trouble, right? I mean, when it drops down 20%, if it's not supply and it's something we don't know yet about global demand, you agree with that?
Yeah.
Price is truth.
Huh? Okay.
Maybe.
All right, coming up, can I do this now? Or
Sure. I think you should.
All right. We've got you covered the whole hour, every angle of this market sell-off. And if you're looking for opportunity amid the chaos, we're going to tell you where investors are running for cover. Plus, check out Goldman Sachs. The stock down a whopping 7%. It's a big move for this Dow component, leading the financials lower, having its worst day since November, way back in 2011. So what's wrong with the big bank? We've got a special report. Then later, the retailer's holding steady despite the selling that we've been seeing in the last couple of weeks. But could all that change when they report earnings? We've got those details. We are live from Times Square in New York City, and there's much more that's right. There's much more fast money right after this.
TV.
Welcome back to Fast Money. The financials taking it on the chin today, dropping 2%. The real culprit was Goldman Sachs, which fell a whopping 7% today for its worst day since way back in 2011. Robert Frank is in the newsroom with more on what's wrong with the big bank. Robert.
Hey, Joe. Well, reports that former Goldman CEO Lloyd Blankfein met with the central figure in the multi-billion-dollar 1MDB fraud has raised concerns that the scandal could escalate. The Wall Street Journal and Bloomberg both reporting that Blankfein was at a meeting with Jho Low in New York in 2009. That was after Goldman refused to open a private banking account for Jho Low over questions about his source of wealth. The Wall Street Journal reporting that Blankfein and Jho Low both attended a second meeting together in 2013. Sources tell me that while Jho Low was on the guest list for that meeting, he did not actually attend. Now, the DOJ has been investigating Malaysia's 1MDB scandal and Goldman's possible role, charging 3 former executives in Asia with money laundering, bribery, and other charges. Goldman says it's a victim of rogue employees who kept superiors in the dark about Jho Low and the theft of billions of dollars from the fund. Now, Goldman earned around $600 million in fees from the sale of $6 billion in bonds for 1MDB. And former Goldman banker Tim Leissner said in his guilty plea that he, quote, conspired with others at Goldman, very much in line with its culture to conceal facts from certain compliance and legal employees of Goldman Sachs. Joe, back to you.
All right, Robert, thank you. Is there still hope for a turnaround for Goldman? Well, hold on. I didn't call on you yet. Hold on. You think it's all planned. I got him last time. Seymour.
Okay.
There you go.
All right.
I didn't see that coming.
Bottom line for Goldman Sachs here, this is a company that's been drastically underperforming the XLF or the financial sector. You could look at Goldman underperforming by almost 25% to the XLF over the last 2 years. So is this a kind of a one-off event that's plaguing Goldman? Unfortunately, I don't think so. I don't think L. Blank, that would be Lloyd Blankfein and co., since we're using these kinds of cool terms. Yeah. I don't think he should be maligned in the context of the entire institution. That's my view. I do think that there are rogue traders. I do think Goldman needs to answer up to it. Bottom line is the market's looking at the potential also of at least what the numbers that are being thrown around are $600 million in bank fees, possibly $1 billion, and people are looking at what this means for a company that doesn't seem to grow revenues like they used to. That's the issue.
Well, that's the point, right? Their business models changed from in the past, or at least they're trying to change their business model. So typically in a volatile environment like we've had, you might look to Goldman to make some money off of trading revenues and all of that. But we know that they are changing their business model. So that's why this stock gets so hurt in this environment. Not only that, the financials have just not performed at all in an environment that they should have performed quite well.
Reminds me of Pete at the top of the show brought up Apple. And he said Apple was the last soldier when you're talking about tech.
It's a good bank.
JP Morgan is the last soldier when it comes to banking. JP Morgan is the only one of the ones that we really look at on a day-to-day basis that's still positive year to date. It's up 1.8%. If it doesn't white knuckle hold that, I think people say, you know what, let's leave that sector alone. That's a utility, but it's not a utility that's offering us any defensive allocations in our portfolio.
I've heard, and I was watching you guys this morning, and I saw several people up there defending the whole banking world. I would join them as well, because I still think there's great opportunities there, Joe. And when I look at Goldman Sachs trading at almost 1 times book, that gets very, very interesting to me. I mean, now I understand the ramifications of what's going on here, and that's big, but I also remember the London whale and everything else. So there are things in the past that have pressed things down and created opportunity. Now, is this the bottom? I don't think it's necessarily the bottom for some of these banks. I actually have a very conservative side and then a very aggressive side. On the conservative side, I have a company, U.S. Bank, regional bank, happens to be out of Minnesota, of course. Yeah, but I really think that do you ever read anything negative about them ever? You just never hear anything, and yet they actually sprawl across the country pretty well, and this is a bank that actually does execute and doing things right. They're actually hanging in there fine. They got a great dividend stream, everything else that you're looking for. I think you have on the other side, when you want some beta, then you have to look at like a Goldman Sachs, probably not even JP. JP's actually pretty safe, but that's what concerns me about a Wells Fargo, for instance, is when are they not a headline somewhere in the financial? Just think about Goldman Sachs. They can't even perform. That's what I'm saying. That's the problem. Right. I mean, even if everything was great, if they had no risks at all of these headlines, they haven't been able to perform when rates are going up and the economy's been strong.
Guess what, guys? the XLF has outperformed the S&P by 3% since October started, when the market's been a mess. So banks haven't been destroyed. In fact, they've been outperforming on a relative basis.
All right. I think I'm going to say take a look at General Electric. We may have seen it a couple of minutes ago.
I
think I saw. Did I see a 7 handle? I did.
7 handle most of
I
the day.
did, and it fell 7%, closing just below $8 a share. We're going to tell you what the CEO said. The latest one, you got it. I mean, they move fast at that place. They had shareholders running from the stock today. An interview with David Faber. Then later, looking for opportunity amid the sell-off. There's one stock in the sea of red today that had Pete Najarian pounding the table.
Really, Pete?
He's on the spot next with a binary answer. He'll tell us the name. There's much more Fast Money live from Times Square right after this break. I'm just going to sleep on a couch.
.org.
Welcome back to Fast Money. I don't know why I'm laughing. A big sell-off on the street with the Dow dropping 600 points. Wasn't funny unless you're out or short. Volatility gripping Wall Street once again. Traders are on the hunt for safety, but not in the usual places. Our very own Mike Santoli, who is like bookends on the CNBC day, is like me, in fact. We're together today down at the New York Stock Exchange with all the details. Mike.
On the 12-hour plan. Yeah, absolutely, Joe. You know, and it's actually this dynamic of quality stocks outperforming the broad market really started to take hold even before we had that correction in October. The run-up in September, you started to see people say, you know what, it has kind of a defensive leadership profile, and that's, I think, been solidified in the last several weeks. So what is quality as defined here? It's not the same thing as value. These aren't necessarily cheap stocks, but they're stocks basically with very strong and stable businesses, you know, powerful brand names, resilient profit margins, also low debt. So strong cash flow, strong balance sheets. Healthcare fits a lot of those profiles. It's been the best performing sector this year, up 11%. And then the rest of it is kind of a Warren Buffett type stock basket, you might call it. Coke, P&G, Disney, Starbucks would be the kinds of stocks that would fall into this general area of quality. The big question is what it means for the broad market, that these are the stocks that have been doing very well, and you're starting to see strategists say you want to tilt toward quality. It's not to say that you were definitely heading for harder times or a continuation of the volatility that we've seen, but if we were headed for a bear market or something like that, this is kind of the profile of the leadership you'd see at this stage right now. I think one of the big questions is, obviously, financial tightening at the same time you're having an economic slowdown means people are kind of hunkering down, figuring out how much more is left in this cycle. Again, not cheap stocks, but an interesting place, I think, that money is flowing in the context of people being a little bit on edge.
Am I going to see you tomorrow, Mike?
I believe 7 a.m.
7 a.m. Be there.
Yeah.
Good, because
I'll change it up a little bit.
No, it's all right, because we were talking Thursday. Remember Thursday and Friday? It didn't feel as great as Wednesday, and now now I don't know what to think. Anyway, we'll look forward to that. Yeah. Look forward to that tomorrow, Mike. So let's see. Got you. I got you. You.
Oh, you're going to me this time.
All
right, I can talk.
What do you think? Should we follow the flock? Flock is a tough word to say.
Yeah.
On this.
You think flock is tough?
Yeah. On this, keep plucking that chicken. On this flight to quality, Brian.
Should I follow the flock? No, you shouldn't follow the flock.
Don't.
Especially no. If these things have run up since the middle of October, now everybody's all of a sudden learned about them, going, "Wow, this is the place we've got to be." BK likes to be on the other side of the boat. Once everybody's run to one side, I'm going to run to the other side, especially the way you look at something the way McDonald's traded today. Opened higher, closed lower, does not look good to me.
What happens if tech continues to sell off?
Then everything sells off. That's my concern.
That hasn't happened in this one.
That hasn't happened in
this case. That hasn't happened with
but I'm saying, that's why I'm saying, look at how McDonald's traded.
This is an alternative to tech.
I haven't grown 6 inches and got an NBA contract yet.
But this is happening. This has happened already. So this has happened in October. So if it continues to operate the same way, you're going to see the same action, and these names can go further.
Okay.
Do you do that often?
Keep hope out.
What? The BK doesn't like that? Jimmy
doesn't like it.
Jimmy does it. Jimmy's mad.
I'm a third-person talker. It's in my Twitter file.
That's weird.
Yeah.
That's weird. That is weird. That is weird.
I can't believe you never knew that.
Okay, BK says we got to go.
For a long time.
That's right.
He's been a third-person talker for a decade. Joe K says we're going to Carter Worth, I think. Our next guest says there's a number of names sitting out the fall. Selling that are worth a buy. Chartmaster, that's cool. Carter Worth is over at the Plasma to break it down. Carter, how you doing?
Sure.
Take it away.
Thanks, Joe. First, we thought we'd do a little S&P just to try to figure out where we could go. What we do know, of course, there's no way out of this, right, is that we have a double top. In fact, that spike high in January, record inflows into ETFs, spiders, and iShares, record. Also, highest RSI reading on a weekly basis since 1990. Pretty classic blow-off, pretty classic double top. And we also have a well-defined trend line. We have bounced once, twice, 3 times. We got here a 4th time. We bounced ever so slightly, but we undercut. And that's the issue. Ultimately, we have a double top. We have a break in trend. Where could we go? There are reference points. If we go just to the low of Monday, October 29th, that's about 4%, 4.5% from here. We close at 27.26. That's 26.03. If we were to go to the February lows, that's the 9th, Friday the 9th of February, that's 25.32. That'd be about another 7.5% from here. Doesn't have to stop there, but at least it gives you some reference point. If and as we go lower, I think we do, where we might go. Let's go to a few stocks. Classic defensive is soap and cereal, they used to say. Humana, it's a beta of 0.8. That's the key, right? It's a low beta stock. And just as is the case, but not with the market, it has bounced off its trend line over and over and over. And it, however, successfully, as opposed to the market, has been able to stay on trend. That's appealing. I like the relative strength. I like the uptrend. Let's do another one. Here's Ecolab. These people do chemicals and water filtration and basically play to the industrial space, but on sort of a safety trade. Here, too, the general principle is it's stayed on trend, has not broken trend, and has gone higher. Let's try another one. Just roll through them quickly. Abbott Labs, it's really the same circumstance. Good uptrends, and then the point is stocks that have rallied, whereas the market has faltered. The bet being that these are relative strength winners, absolute winners. Thermo Fisher, really it's the same thing. I'll just move along. Let's go to the next one. Here's, baking soda. This is the same principle. These all act very well. The last chart is a basket of those 5 stocks. Humana, Ecolab, Abbott's, Thermo, Church & Dwight. Is this not the very definition of a virtually perfect uptrend? And I'm going to make the bet that if it's going to roll like the market, you'll have plenty of time to figure that out. But for now, the bet is otherwise, up and to the right. Quality stocks, or you can call it whatever you want. It's defensive. I think it's the place to be.
Chartmaster, come on over here. You're flying colors. I mean, you get invited over.
I got the red.
Invited over to the. Was there any precipitation likely in any of those things overnight? Can you Which ones?
Exactly.
Hey, so these mics are on at all times. Is that what I just heard?
We actually keep it cool when
That's
when
fun,
the guests
isn't it?
are on.
Yeah, the mics never go off. That's whoa, that's dangerous. Carter, do you have any names that are your favorite in that group?
Yeah, I would say Abbott Labs, probably best in class, meaning just steady. But Humana is quite good, and not shown there is UNH. I mean, these are both absolute winners, and then the key is we know this. When a cycle goes, you have bifurcation. We had that, semis, industrials, financials, but the market stayed up. Then they break the high flyers, Square, Microsoft, Adobe, Amazon, and then people cluster into defensive names. It's really not over until you go after those, which is what your point was. Really, 3% in the 2-year note's not so bad right here.
So, Carter, when I look at the S&P where you started out, now I'm negative as you are. I believe that we feel like we have a little more further to go. But I saw something today that could possibly be an inverted head and shoulders.
You're talking about that minor head and shoulders from the... Sure, that's very possible. I think it's maybe hoping. I mean,
I think it is.
I think it's hoping, you know, the chart in the S&P and seeing a minor head and shoulders bottom. I think the issue is this. The damage done is substantial enough that we heard how long on average it takes to get back to a new high. But the further we sink individual securities, the more likely it is that this topping process that's been underway, frankly, since the blow-off high in January, is enduring in nature.
Especially with a 4% weight like Apple and some trouble here. But you've talked about in past shows, it's not a bad day to remind us the bottom of the channel on the S&P, where we could still stay in this bull zone and actually just be respecting the bottom end of this uptrend.
That's right.
Where are we?
Let's say we get to the, well, if we were to get, you're talking about the 10-year sort of chart?
Sure.
Well, that would be 2,300. But if you just look at the bottom of February 9th,
25.32.
to go down another 7.5%, that would get it. But here, let me maybe end with this. I think the worst single thing we could have done is the fact that we bounced 8% off the lows of the last 2 weeks. What you wanted to do was actually go down another 7. Not because I'm rooting for down, but then you can get a cathartic capitulatory bounce. The fact that we bounced 8%, some stocks 20 and 30, that keeps hope alive. People say, oh, it's okay, year-end rally. A year-end rally, listen, they talk about the statistics. Unless you have 200 inputs, we only have 100-plus years of inputs in the market, it's statistically insignificant. And buybacks, these are all just hope. We don't know that we get a year-end rally, and we don't know that we get buybacks. That's not a thesis. It's not a premise. It's not a strategy. It's just maybe it happens, maybe it doesn't.
We didn't close down 10% on anything, right? Maybe the
no, individual. A lot of individual stocks.
No, I know. No.
But the S&P, I mean, peak to trough decline was 11.47%.
Didn't close down 10, did it?
No, but intraday prices, it's like saying.
No, I know, but yeah. I mean, for a decent, you're looking for a toilet. You're looking for the flush, right?
Well, what you want in order to get it back, you've got to get people out. You've got to shake people out. If you look at the most widely held stocks at Merrill Lynch, at Schwab, at any of the online brokers, it's still the same names, and people haven't abandoned them yet. It takes a lot of damage for people to finally give up on their beloved winner.
Yep. Right. All right. Carter Worth.
Well, you are beloved too, Carter.
Yeah. You earned this spot at the desk. You did.
Does it come with a coffee or anything?
Yeah. Whatever.
No, that's extra. Coffee's for closers.
Oh, that's good. Okay. Coming up, General Electric getting crushed again today. Down 7% to a 7 handle. As the CEO, Larry Culp, was on CNBC earlier this morning. We'll bring you those comments. Plus, it's not just GE sinking today. There was a sea of red on Wall Street. I'm surprised any of that. They got that little green stripe. The Dow and S&P both dropping 2%, but Pete Najarian says there's one name that could survive the sell-off, and he's going to guarantee us that. No,
guarantee.
He'll tell us what it is when Fast Money returns.
And whether it's an equity analyst, whether it's the rating agencies, witness the downgrades, or what we said ourselves, we need to bring the leverage down. And I think we've got plenty of opportunities through asset sales to do that. In the last 6 weeks, this is my mark 6 weeks on the job, I've heard from lots of people across our markets, people who have interest in GE assets. And I think that's confirmation that we have quality franchises and, frankly, that we have options.
And that was newly appointed CEO of General Electric, Larry Culp, speaking with our own David Faber on Squawk on the Street this morning. The stock falling below $8 a share, closing right there. Tim, you're a GE shareholder. What do you do now? Buy yourself a Venti latte?
I'm not sure it's going to buy that, Joe.
Maybe a grande. I think actually it's a grande.
Well, not Starbucks anymore because Starbucks' prices have gone up.
Yeah,
it's a tough time for me. Look, anyone that's holding out hope for a massive turnaround anytime soon is certainly in the wrong place. And for me, with it was a 35 basis point position. It's not one that to me is material. But here's the most important point: every dollar I lose in the stock's a new dollar. So, what have I learned in the last couple months? First of all, what have I learned in the last couple days? The numbers that we've gotten out of this company since earnings, and even some of the guidance we've gotten recently, tells you that the run rate on fundamentals is deteriorating significantly, and that consensus cuts are still happening. So at some point there has to be this stop loss mentality for people that own this stock, and you have to ask yourself, first of all, what don't you still know? And I think Larry Culp, everybody gives a lot of credit for being out there, being accountable. The asset sales to me are very important, and I think we need to see something in the short run, even though you can't sell something when you go in drooling, Pete.
The biggest issue I have right now is, he says, yeah, we need to sell some assets at some point. Well, everybody knows that, right? So who's got you always want to be the side of power. Right now, GE's not on the side of power, and their power obviously is a big problem as well.
No pun
but I looked from November 1st, Joe, all the way until now, right? 6 separate occasions so far. All we've seen is monstrous put buying, and they continue to be right. I went back a year ago. They were buying 100,000 puts when the stock was trading in the upper teens. I mean, it's amazing how right the options market has been in this particular stock in terms of looking at what the management's doing, the fact that they were always reactive, not proactive, and the fact that, unfortunately, because of that, they have assets that do have value, but not nearly the kind of value when they were actually chasing them. They were running to the high end
on the books, possibly.
Right.
So I mean, the reality is that's the big.
Yeah. So I actually own it. Not too far. I'm not being that guy. Not too much higher than where it is right now. But I will tell you, when we just said about the flush in the overall market. Yeah. I felt like we're getting the flush. Granted, it's an everyday occurrence with GE right now. Yeah. It's an everyday occurrence when you get the flush. Today was sort of constructive in a vomit world of GE.
Not sure what that means.
It looks like to me it's building a little bit of a base here. So we'll see what happens to the overall market.
You always, I was a stockbroker for 10 years. You get down to 7 or whatever, and you say, well, how much further can it go? Yeah. You can still lose 100% of your money. You can still lose 5. Doesn't matter. You can still lose 100% of your money,
and that's some of the parts thing.
Did you marry your losers? And I'm not talking about my wife. Did you marry your...
the problem is what human nature... What human nature is we sell our winners too quick and we hold on to our losers too long. And GE is a loser that I've been holding for too long. But I am.
Was it double digits when you bought it? So it wasn't 9 when you bought it?
No, it wasn't 9. It was double digits, yeah. But it was low double digits.
All right.
If you're counting to $1 million, it was very yellow.
Tell me I got to go.
Taking you to task here.
Yeah, I know. You want a statement?
Marry your losers. Mrs. Grasso did that. No. Coming up, it was the brutal day on Wall Street. The Dow dropping 600 points. S&P and NASDAQ. I used it on me, and then I use it.
That's fine. It all works.
NASDAQ also getting hit hard. But Pete has one name he says could rise above the selling. He's going to tell us what it is. Plus, it's a huge earnings week for the retailers. Are any of these names a buy ahead of the holidays? Stick around to find out. More Fast Money right after this. Welcome back to Fast Money. It was a sea of red on Wall Street today. The Dow and S&P falling around 2%. The NASDAQ more, 50% more. In fact, down almost 3%. But Pete Najarian says that there's one name that could survive the sell-off. He's over at the Plasma with his fast pitch. Pete, what stock are you looking at?
It's going to be Lululemon, and I will tell you this right now. The PE is very high, so that's one thing that in this challenging market, Joe, that is something you have to deal with. But even on a day like today, it didn't get hit that hard. Here's why I like it. Here's my 3 points. The solid management. Now, the chairman himself actually loves who the new CEO is. This guy a year ago, by the way, Mr. Murphy, a year ago bought 100,000 shares in the 60s. Now the stock's in the 130 area. So he's got a lot of faith in their company, and in terms of the CEO, absolutely thinks it's the ideal pick. It's a new CEO, so that's something that you have to keep in mind. But I like what the direction of this company is. The incredible buybacks. You look at the fundamental story of this company. One of them, Joe, is the buybacks. When you see the kind of buybacks they're seeing now, they've shrunk their share count by 9% since 2014. That's some great buying. And oh, by the way, they didn't do it by debt. They didn't finance this thing. They did it with cash, which, by the way, when you look at their balance sheet, they have zero debt, nothing like GE, but they also have $800 million sitting there as well. So a great looking side there. But the one issue is you do look at the multiple. It is pretty high. I'm going to tell you that. But they're growing. And where are they growing? The double-digit growth. Earnings, that's up 20+%. Revenue in that 20% area as well. So great. The idea that we're seeing right now in terms of growth, I love it. Here's the chart.